Hello and welcome to this episode of Live with Lizzie. I am your host, Lizzie. Joining me today is Mr. Michael Hirson, Head of China Research at the New York-based 22V Research. Thank you so much, Mr. Hirson, for joining me.
Great to be here.
So, Mr. Hirson, what do you think is the most important message of the recently concluded 20th Party Congress that the market should take notice?
Well, there were several messages. I think the trick is that some of the messages were fairly explicit, and then there are also quite a few messages that were more implicit. I would say the explicit message is that Xi Jinping really continues on a course that he's already outlined in terms of where he wants to take China, both in terms of economic development, social development, geopolitics. So no radical turns here. There are some themes that are rising in importance. Economic security, I think, is a really critical one for the markets to understand. And then common prosperity as well is sort of coming back now on the agenda. The implicit message, I think, is also quite important, which is that clearly, and you see this in the leadership team that President Xi selected, he clearly values political loyalty as a key criteria for how he's making his leadership choices. And if you think about the voice that more pragmatic officials might have on economic issues, I think that's also a very important implicit message for markets to take away as well.
Mm-hmm. So as you briefly alluded to, the new leadership is really stacked with Xi Jinping's allies, which seems to have scared off international funds, at least initially, who had hoped for a more market-friendly turn after the party congress. So what do you think is the implication of the new leadership for the future of economic policy making of China?
Well, I think the markets are still struggling to understand how to put this into context. And to some extent, you could say maybe that the short-term reaction has been overdone, although I cannot very much understand why the long-term reaction in terms of how people are thinking about the overall trajectory for China would be something that people are reevaluating. I think, the bottom line is that there are fewer voices in the leadership that are likely to have the willingness and the capacity to really push back on political priorities that come from the national security side of the house, in particular, that impact economic decision-making. And that means, when we mentioned earlier, economic security is going to be a key theme. I think economic security is going to swamp some of the other quite important areas of pragmatic decision-making. I think that's a risk for China's overall growth trajectory. I think that's at the very macro level. I think this lack of kind of pragmatic moderates in senior leadership positions likely also means we're going to continue to see a pattern of policy overshooting in China, where policy is implemented in this very top-down campaign-style fashion. And even if the objectives are quite sound, like financial de-risking or environmental control, still that policy overshooting, that campaign style of implementation can really create a lot of economic uncertainty. So I'd say those are the key implications. I also just think the context here is quite important, which is, in my view, Beijing's margin for error is shrinking in the sense that China's growth model is running into, mounting constraints. Talk about debt, demographics, stalling productivity growth, geopolitical tensions are high. So there is, I think, a real need for nimble, pragmatic decision-making. And that's one of the risks that I think markets should take away from this party congress.
Another thing that's very much on investors' mind is a zero COVID policy and COVID-related restrictions. After Xi Jinping secured his third term, will Chinese authorities begin to meaningfully relax those restrictions?
I think it's quite possible, but I continue to be quite cautious about expectations for moving away from zero COVID. And it is by far the top question that investors have when I speak with clients. But people continue to think that this might be, now that the party congress is over, some kind of rapid shift. And I think it's really important to emphasize that the continuing priority for China's leadership is going to be avoiding a serious surge in serious illness and death. And if you take that as the fundamental assumption, it means you really have to be looking not only at the signaling and the rumors and the reports about a pivot from zero COVID, but you also have to be looking at what preparations China is taking that would allow a pivot to happen. And I think looking at the public health side, it seems to me that there's quite a ways to go before China has the preconditions such that the leadership would feel comfortable relaxing this containment strategy. So the bottom line is, I think there will be an evolution of zero COVID, probably in 2023. But I do think that the pivot is going to be slower to take place and is going to be much more cautious than I think still a lot of investors expect.
Right. And Xi Jinping's signature Common Prosperity campaign seems to reinforce a priority shift away from the focus on GDP growth. What will China's economic priorities be for the next few years?
Well, I think it is this clear emphasis away from rigid pursuit of GDP targets to, what I think Xi Jinping would consider high quality growth. Mm-hmm. And high quality means delivering on quality of life issues for China's middle class, including an emphasis on poverty alleviation. And I think that's where common prosperity comes in. And that's got a very political motive as well. But it also means high quality from the standpoint of where China needs to go to continue its rise as a great power. And I think that's really where the economic security theme comes into play in a big way. And the way that I think about it is, I think Xi Jinping is really out right now to build a more geopolitically resilient economy with the backdrop of US-China tensions that he sees so clearly. That's a resilient economy is not necessarily a high efficiency economy or higher productivity economy. And I think that's the wrestling match that we're going to see. But clearly that emphasis on high quality growth as Beijing defines it remains absolutely central to economic policy right now.
I see. And speaking of policy overshooting, China's real estate market is undergoing a liquidity crunch, very much at the risk of snowballing into defaults. Will the central government bail out those troubled developers?
I think it's tricky right now. In my view, I don't expect Beijing to really to bring out the big bazooka, so to speak, in terms of the financial backstop for private developers. The problem has gotten so large in terms of scale that it really would take a lot. And I just don't see any indications that the political appetite is there at the central government level and the financial capacity is not there at the local level to really come to the rescue of private developers. So I think it means that we are in for a continued long haul here in terms of this property downturn, and it's going to take quite a while, even after property sales rebound. It's going to take much longer for property investment to rebound because the private developers face such difficult financing constraints and have a lot of debt repayments that they are liable for.
I see. Foreign investors are on track to turn net sellers of Chinese equities for the first time ever this year. This is according to Bloomberg data. At this point, is China still a buy?
Well, I think that's a tough question because it depends on, who the investor is, what your time horizon is. I do think that it's trickier than ever these days for institutional investors to just allocate a certain portion to a China benchmark and leave it at that. The ESG concerns, environmental social governance concerns that Western investors have, I think are getting trickier to navigate, especially for public funds like pension funds, where they're really scrutinizing the kinds of Chinese companies they invest in. The political cross currents are hitting more sectors in China than before. So I do think it's a much more difficult path. I think for a lot of investors, it will make sense from an investment standpoint to maintain an allocation to China. I mean, it is the second largest economy. A lot of thriving companies, but I think bottom line is I think it's harder to just set a passive benchmark for China and leave it there. I think it requires much more dedication and thoughtfulness in terms of what kind of exposure you have.
If you enjoy our discussions here, I'm sure you would find value in our new powerful marketplace tool for investors, also called China Edge. It tracks, distills, and analyzes both Chinese language and English language materials about Chinese companies, business leaders, and government entities, and reviews the often hidden links between them. For our YouTube viewers, we are offering a limited time 50% discount. Just go to the link you see on the screen and use the code EDGE50. Also, sign up for the China Edge newsletter. It's a daily 2-minute rundown of China business news you don't want to miss. The link is right here on the screen. You can also click on the link in the video's description section to get your complimentary subscription today.